One popular measure of volatility for investors has been relatively subdued over the past few months. The CBOE Volatility Index, known as the VIX, is off more than 3% so far this year, indicating expectations for volatility in the S&P 500 have been somewhat muted this year. Some on Wall Street believe that that's about to change, though, as uncertainty around the Fed's potential rate cuts, plus a presidential and general election, could see market volatility spike. For more, I'm joined by Anthony Saccaro, who is the Providence Financial and Insurance Services President. Anthony, great to see you and great to have you back on the program. What are the best ways to protect oneself against a potential market downturn?
Yeah, I think what you really want to do is you really want to focus on the phase of life that you're in and the strategies that you're using for that phase of life. The fact is that if you're heading towards retirement and you have more than 10 years away to retire, you should continue doing what you're doing. Dollar cost averaging, have money come out of your paycheck every year, every paycheck, continue driving that average price down. That's what dollar cost averaging does. I wouldn't change anything there. But if you're a little bit older, if you're maybe a decade or so, especially if you're 5 or 10 years or less away from retirement, you probably want to start shifting from the more aggressive investments, which have served you well over the last 10 or 12 years, into more conservative income-based investments. And if you're retired, same thing. It starts shifting from a growth-first, income-second mentality to an income-first, growth-second mentality the closer you get to retirement. I think that's the number one thing you need to do. And with the market at record highs, it's not a bad time to start making that shift.
So what are the three risks in the back half of 2024 that investors should be paying closest attention to that could insert more volatility into the equation?
Yeah, well, certainly inflation is one of those risks. It has softened. It has started to come down a little bit. It stalled in the first quarter, came down a little bit, right? The PCE and CPI numbers were favorable, not by a lot, but we'll take it. And that's certainly one risk, that the price of things stays high. That makes it more expensive to live, makes it more expensive for credit, makes housing costs more expensive. So that's one risk for sure. A second risk is that we have a recession. We're not out of the woods yet. The labor market is softening. It's not soft enough. The inflation, as we talked about, is softening, still not soft enough. We still have an inverted yield curve. An inverted yield curve indicates and has indicated historically that we have a recession coming. Our yield curve now has been inverted for more than 2 years. That's not uncommon for an inverted yield curve to be that inverted that long before a recession happens. Additionally, the expectations index is under 80. Generally, under 80 has been a good predictor of recession. So we're not out of the woods. A recession is potentially a risk as well, too. And I think geopolitical risks are there as well. The trade tensions with China, the tariffs, the presidential election is going to come into that. And we can't underestimate still the fact that there could be a terrorist event. We've had it happen before. Our government's done a great job of protecting us, but we've got some wars going on. And if we had another terrorist event in this country, that could be a risk as well, too. So I think those three are the three to really focus on and to do what you can to mitigate at this point.
Wow. Yeah, that last one wasn't on my bingo card, and I'm hoping it doesn't come true. But of course, exogenous threat that many investors always have to think about here.